Hey everyone, welcome back to the Longacres Finance channel, where the mission is to find the best high-quality dividend stocks for safe, reliable, and growing passive income streams. If that's your goal as well, subscribe to the channel and join me on this wonderful journey. Today I want to take a step back from my usual dividend focus and take a look at the entire stock market. I was recently thinking about how much luck plays a role in the results we attain in the stock market. While an individual has a great deal of control, like what they invest in, how much they invest, and for how long, there are also many factors outside of our control, like everything that will happen in the future, and which period of time we have the ability to invest in. We have no control over when we were born, and therefore we are presented with a given 30 or 40-year period of time to build our investment nest egg. I know, some of you are probably thinking if you start early and live a very long life, you could invest for 60 or 70 years. That is absolutely right. I'm trying to think in generalities here, and I would say that the vast majority of investors have this period of time between their 20s and their 50s that is a primary return-seeking portion of their investment career. Once you enter your 60s, most investors probably have a much different outlook and expectations from the stock market and their portfolio. Let's just focus on a 30-year investing timeline to not make this more technical than it has to be. So with a 30-year timeline, a person born in the 1950s would have the 1970s, 80s, and 90s as their primary investing years, and someone born in the 1970s would have the 1990s, 2000s, and 2010s as their primary investing years. This is the luck factor I was pondering. We are exposed to a certain period of the stock market, and looking back at historical returns, not all periods were the same. Some people are exposed to the stock market at better than average times, while others see much worse market conditions. We have no way of knowing how the stock market will perform during our period going into it. It's only when we look back in history that we can analyze which period was better and which one was worse. Let me give you an example of what happened to Bob. Bob turned 20 in 1972 and started investing a fixed amount of money into the total US stock market each year starting in 1972. And he did this for 30 years with the hope of retiring at the age of 50. He put in $500 each month into his brokerage account and did not try to time the market or pick his own individual stocks. He just added $500 to an index fund each month like clockwork for 30 years straight. If Bob started in 1972 and continued his investing pattern for 30 years, that means his last contribution was in 2001. I bet Bob had no idea the end of his prime investing timeline and the start of his early retirement would be in the middle of the dot-com bubble. But let's see how this investing approach worked out for him. Bob got off to a great start, seeing his account gain 17.62% in 1972. This was followed by two consecutive down years, as the total US stock market shed about 46% in 1973 and 1974. But this correction did not deter patient Bob. The correction years were followed by 2 years of strong returns, then another small down year in 1977, and 2 more positive years to finish out Bob's first decade in the stock market. At the end of 1979, Bob's portfolio was worth about $74,000. With about 65% of the money coming from Bob's contributions. The 80s were kind to Bob, as he only had 1 year with negative return in 1981. He finished the second decade of his investing journey with a portfolio worth about $482,000. Bob had 12 years left in his 30-year investing plan, and almost $500,000 in retirement assets. The 90s were also kind to Bob, as there were only 2 years with negative returns, 1990 and 1994. The second half of the 90s was very kind for investors, as the market on average gained about 27% per year between 1995 and 1999. Bob's portfolio broke $1 million valuation in 1995, and during the following 4 years as Bob added another $24,000 to his nest egg, the value of his portfolio tacked on an additional $1.5 million, thanks to Mr. Market. Now only 2 years away from his planned retirement, Bob is sitting on a cool $2.5 million portfolio. Most people already know what happened next, but Bob didn't. In the final 2 years of his 30-year investing journey, as Bob added his final $12,000 in contributions, he watched the market value of his portfolio decline by $500,000. While it may have been a painful period of time, it didn't prevent Bob from retiring early. A $2 million portfolio was a good chunk of retirement cash. On top of that, this was 2001, or about 20 years ago, so the value of each dollar was considerably higher than today. Let's take a quick look at how Bob's retirement would have played out between 2001 and today. If Bob used the 4% rule to access his retirement funds, for anyone not familiar with the rule, you basically withdraw 4% of your portfolio each year, and ideally the market will offer higher returns to compensate for the distributions. So in 2002, Bob would have taken a distribution just shy of $82,000 to fund his first year of retirement. Not a bad place to start if you ask me. However, the market was not kind that year, and Bob's portfolio fell to $1.55 million. This meant that in 2003, Bob could only withdraw about $62,000. A $20,000 cut in income is significant, but you can still manage to live on that level of cash. I'm not factoring any tax burden here, which would definitely make these amounts much smaller. Between 2003 and 2007, the market offered decent returns, and Bob's portfolio climbed back to almost its highest amount. At the end of 2007, the market value of Bob's portfolio would have been about $2.4 million, and his annual distribution amount would reach around $97,000. Just when everything was starting to look great again, Bob was going to go through another market crash. In 2008, his portfolio lost almost $1 million, and his distribution in 2009 was sliced in almost one half. However, the market recovered from the recession in 2009, and Bob's portfolio grew by $350,000, even after his annual distribution. In 2013, Bob's portfolio market value climbed to a new all-time high of $2.8 million, pushing his 2014 distribution above $100,000, $112,000 to be exact. Also in 2014, Bob's portfolio would climb above $3 million. In 2019, it would hit $4 million, and $5 million in 2021, with his distribution amount never dropping below $100,000 ever again. Barring a major correction in the second half of 2021, Bob could expect to receive more than $200,000 in 2022. During his 30-year investment period, Bob contributed $6,000 to his portfolio every year, for a total of $180,000 in contributions. When he retired with the $2 million portfolio, 91.2% of his portfolio was a result of market gains, and the other 8.8% were his contributions. It took less than 3 years for Bob's portfolio to return all of his contributions to him, excluding any tax burden. In the first 13 years of his retirement, Bob's portfolio paid him over $1 million. It took 19.5 years for Bob's distributions to exceed $2 million. Over this almost 20-year period, while Bob's portfolio paid him distributions equaling its initial value at the time of retirement, the assets more than doubled. They grew by 162% to be exact. Obviously, it's quite different looking at how this played out from a historical point of view, and it's much more difficult to make decisions like retiring early with the uncertainty of the future. But what we can learn from Bob is that consistency and patience are essential tools when it comes to long-term investing. Picking a solid investing plan and retirement strategy are key, but what is more important is to not let your emotions deviate you from that plan. I want to show you how differently this scenario could have played out for a different time period. I'll use Tom as an example. Tom is Bob's younger brother, who was born 7 years later than Bob. Bob convinced Tom to follow the same investing plan as him, and Tom did, except he started this journey in 1979, exactly 7 years after his older brother. I'll go through Tom's journey faster, since there's more I want to get to beyond this example in this video. Tom started in 1979, so he would retire in 2008, right during the financial crisis. If you're thinking I cherry-picked these time periods, then you are right. I picked the best and the second worst time period. Halfway through his investing journey, Tom's portfolio has grown to about $307,000. His older brother Bob's portfolio was around $309,000 after 15 years. So they were in about the same boat at the midway point. Tom's portfolio peaked in 1999, crossing $1 million after 21 years of investing. It took Bob 24 years to break $1 million. Tom's journey was derailed by the dot-com bubble. It took another 5 years for his portfolio to climb back above $1 million. And it tacked on another $300,000 in the following 3 years. But right when it came time to retire, the financial crisis happened. Tom's portfolio fell from $1.37 million to $870,000. Tom lost 36.5% of his retirement funds the year he was looking to retire. This meant that if Tom did indeed retire as planned, his first year 4% distribution in 2008 would have been just shy of $35,000. This is considerably less income than Bob had for his first year. It would take Tom 11 years into his retirement to have a distribution equal to his older brother's first distribution. Beyond 2008, it was pretty much all growth for Tom's portfolio and distribution amount, but the decision to retire after such a market drop would have certainly been tough. Tom's retirement portfolio would have paid him about $779,000 during the first 13 years of his retirement. His older brother Bob received $1.07 million during the same time period. To make things worse, Tom retired later, and due to inflation, his buying power was lower than his older brother's. So what can we take away from this example is that luck plays a significant role in our returns from the market, specifically the randomness of which years we are invested in the market. Obviously, that is something we have very limited control over, and we have to make the best of the time at our disposal. Instead of worrying what returns future years will bring, we should focus on things we have full control over. The most important factor for me to building a large retirement portfolio is the duration we are invested in the market. This means we should start investing as early as possible. The second most important factor is where we invest our money. You want to pick an asset allocation that has been proven to work, and one that will give you exposure to at least market average returns. You also don't want to take on too much additional risk. This will vary wildly from person to person. I would say that if you are not confident in picking your own stocks, or you worry that you may underperform the market, just invest in a broad equity index fund, like the total US stock market. Over a 30-year period, it worked quite well for both Bob and Tom. If Bob and Tom both extended their investment period from 30 years to 40 years, they each would have retired with portfolios in excess of $3 million. that would have produced annual retirement income greater than $100,000 using the 4% rule. In fact, over a 40-year period, Bob and Tom's portfolios would have been the two worst 40-year periods for someone starting between 1972 and 1982. There isn't enough data beyond 1982 to compute a 40-year return. But if the worst returns build a $3 million portfolio, I think if the past repeats itself, we will all be just fine when it comes time to retire. The best 40-year time periods would have been 1974 to 2013 and 1975 to 2014. Both time periods would have generated portfolios in excess of $4 million. The third factor that is also important is how much we are contributing. You want to make sure you contribute as much capital towards your retirement in the early years as you can. That money will have the most time to grow and compound. It is very difficult to play catch up later in life. Let's finish here with just a recap of what I think are important aspects to investing and building wealth. Start early, contribute as much as you comfortably can. Pick a simple and proven investment strategy. Be consistent, and most of all, be patient. That's it. Let me know if you have any questions in the comments below. Thank you for watching. Don't forget to subscribe, and see you next time.